There we go. Okay, sweet. So, US dollar, as I said, just to quickly recap, obviously, if people are watching the recorded version, the US dollar, I'm willing to basically bet that we're, if not already at the bottom, we're approaching it very, very quickly. Um, so, I put this presentation together basically just to cover why I think that and basically what is the situation outside of the bearish technicals, what's really moving the market and where can we expect it to go. So the dollar's had a 10 to 11% drop this year, which has been, again, very brutal, especially for dollar bulls. We obviously had a very, very bullish dollar at the end of Biden term into Trump's term. Obviously, we named that the Trump trade. That's just what it was typically known by. Sentiment across the board is broadly bearish, especially from institutions. Retail, obviously, always are on the wrong side, so they've been actually very bullish on the dollar. Um, so the positioning, the technicals, and the macro liquidity conditions are all suggesting that we have either bottomed or we're very quickly approaching the bottom. Now, of course, we don't predict this type of thing, so we'll sort of move into if we are going to execute and how we're going to execute slightly later in this meeting. Um, so what caused the dollar drop? Obviously, there was on the surface, there was a lot of tariffs have made the dollar drop, blah, 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 which is half true, but that's not all that we had going on. A big thing and a big factor for the dollar dropping has been essentially just dollar hedging. So we've seen the drop wasn't due to foreigners dumping US assets. Total foreign holdings of equities and treasuries remained stable. Treasuries remained stable. Instead, foreign investors increased FX hedging of the US dollar exposure, which mechanically created US dollar selling pressure. Now, of course, we've also had the narrative of the Fed is going to cut rates pretty much all year. I remember back at the start of the year, oh, the Fed's going to cut rates early 2025, and then that's been pushed back, pushed back. We've seen massive front running of Fed rate cuts for July, which have obviously now been completely dampened. On top of that, that massive front running was also from my view, it was institutions, smart money betting that the labour market was going to crack, which hasn't happened. Again, we had NFP come out very not amazing, but it was resilient. We got 147K, which beat previous, beat forecast. We had jolts that was very, very good. We've had unemployment drop to 4.1. So if anything, the labour market has done the opposite of what smart money was betting on, really. And again, those Fed rate cuts just don't seem to be coming, in my view, which again, we'll move on to. Um, so not a structural decline. The hedging activity, and this is obviously covering on the first topic I mentioned on why the dollar fell. The hedging activity that pressured the US dollar is likely temporary. It's not a structural exit from US dollar assets. So what that means is that the US isn't just, it's not that foreigners have just given up on the US and now they're selling everything US related. It just means that they've hedged their positions, if that makes sense. See, the problem is that was a reasonable option. Look back at 2014. So this is essentially telling us the return or the yield. However, at the moment where we are now in 2025, that's negative. So it's very expensive to continue to hedge, which is obviously a big reason the dollar has dropped as much as it has over the past couple of months. So it's not really a viable option to continue the way that they've been moving in terms of their hedging. Now let's move on to the smart money. I'm not going to cover this exactly. As I said, you've already got this, so you can read through it in your own time. But the COT positioning broadly is very bearish, and it's the most extreme we've seen in over a decade, with over 59% of net positioning being short, which is huge. So we just quickly look at this screenshot again. I've mentioned this previously in other webinars in the past, but 50% of longs and shorts is pretty much the support line of COT. So I don't think I can zoom in here. Oh, I can. Okay. Can I scroll? Yeah. So we can see here, every time we get to less or 50% or less in terms of shorts, or sorry, 50% or more in shorts, we often have this pop to the upside in long exposure. Now, this is why I call this a support. This is broken. Now, of course, I'm not trying to turn this into a technical chart. That wouldn't make sense. However, we can use this as a reference and sort of a historical behavior of COT and smart money. So this is out of the ordinary, and it does tell me that the market is extremely crowded and it's overstretched. It's and again, I hate to keep saying this, but again, I say this very often that investors are basically retards. They're very sensitive to everything. So they see something that maybe shakes their confidence, then they'll see someone else selling, then they'll sell, then someone else sells, and they all just jump in and it snowballs. And I'm willing to bet that they're all wrong at this point. Excuse me, which again, I'm going to touch on COT a bit more in a couple of minutes. So recession, there's again the argument that the US is going into recession, which is a valid argument to make that they could be heading there. But to say they're already in recession, the data is not suggesting that. However, if we do end up in recession, this is a point historically you would want to buy the dollar. So it's not uncommon that we do see the initial drop. Obviously, fears, sell dollar, sit on cash, buy gold, etc. But as that fear gets sort of priced in, we actually, again, through history, we do see the dollar perform very, very well in recessionary periods. So once the GFC was officially started or officially began back in 2000, and I think it was the end of 2007, it officially began, we did see the dollar drop about 10% on a technical basis. However, again, once that got priced in and we saw the credit risk or credit event and full recession indicators flashing red, the dollar then decided to run 25% to the upside. Same thing in 2020. We did run 9% in 2 weeks to the upside. So if it is recessionary fears that are driving the dollar, it is possible that we are reaching the bottom before we start having upside. And again, that's assuming that people do think we're in recession. I don't think we are, and the the macro indicators don't suggest we're in a recession yet, or the US is in recession yet. Macro landscape, as I already said, we've had NFP, we've had jolts, we had unemployment, all do very well. A big shock to the markets was ADP, which came out at negative 33K, which was a big shake. I'll be honest, I was expecting weak ADP, but negative 33K did catch me off guard. Luckily, ADP is something not many people care about, so that wasn't a huge market mover, but it did shake confidence, which again, NFP, jolts, unemployment, services, and manufacturing were very good last week. So the technicals align. I'm not going to go into this too much. Again, we're going to go into the charts, so I can cover the technicals on there. However, just to quickly recap, we are in a multi-year trend. We're at the bottom. We have got very clear cycles in the dollar where we have these contraction expansion periods, and it looks like on again a technical basis we could be coming out of the current contraction into the next expansion. Euro dollar, and this relates to quite a lot of dollar pairs, are very, very extended to the upside. Again, we'll go on to the charts in a few minutes. So repo spike. Now, this is something I don't think I've ever spoken about because I've never really needed to, but it does seem like it's a relevant factor at the moment. So essentially, what a repo is, and I'm assuming that you guys haven't heard of a repo or you don't know much about it. Um, in a nutshell, it's when a bank or an institution will sell treasuries to the Fed or to another institution for basically quick cash. So what this tells us is there's a liquidity stress. So you would only really see this if they're running low. They have demand for dollars. They need dollars for some reason. It could be whatever reason. But obviously, if they're needing dollars, tells us that there's demand there, supply is low. Um, so 11 billion is a large amount. So again, it's nothing huge. This did happen last week. So I think if we were going to see a huge move due to this, we would have already seen it. So I'm not counting this as a massive thing, but it is something I want to keep in mind. And another thing just to quickly think about is last week was very low liquidity. We did have July the 4th. So obviously US markets were closed on Friday. Thursday didn't see much volume at all apart from NFP. So there's that. So the US dollar's push and pull, the bullish and bearish drivers. So bullish drivers, obviously, we are seeing extremely, or seeing an extremely crowded short market on the dollar, which obviously is good for a short squeeze. Contrarian thinking is always good when we see crowded markets. Think about when we saw the S&P crashed, DAX, Dow, all of them crashed due to the tariff news when they all dropped, what was it, 25% roughly? Everyone was bearish. Everyone thought this was the end times. We're in recession. Tariffs have destroyed the markets, blah, 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 blah. As soon as we hit that sort of 20% pullback or 20% crash level, the markets rallied and everyone was extremely fearful at that point. So again, just feeds into that contrarian idea. Sticky inflation, and also recently the positive labor market has put absolutely no force on the Fed to cut rates for July. Again, institutions, smart money front ran that, and they were wrong. Fed staying higher for longer. Obviously, they're holding rates. Strong US growth and yield advantage. US, obviously, interest rates are still relatively high. Inflation isn't too bad, so the yield on there is pretty nice for the dollar or for investors to hold the dollar. Liquidity stress in the repo market, as I just discussed. I might go into the repo market in a completely different video to explain it fully, but it's not huge, it's not a massive thing just yet. But if it does, then I will do, or if it does turn into something big. The reserve currency, obviously, the dollar is kingpin of the currency markets and of the globe. Can't be argued unless we see de-dollarization, which I, again, don't think would ever happen. Or if it does happen, it wouldn't happen anytime soon. So bearish drivers, recent FX hedging flows by foreign investors caused selling. Market pricing premature rate cuts. Again, they were front running it and they were wrong. Equities are strong, keeping the US dollar risk off flows muted, and political risk and trade war headlines remain a headwind. So, what could cause the reversal? So, again, we've already had really pretty good news for the dollar. So, we've got three stages at the moment. We've had the bearish, oh my God, what's going on, sell dollar. We had that period. That's, in my view, that's done. Now we had the NFP, jolts, unemployment, blah, blah, blah. We had that, and that was a case of, okay, maybe we were a bit too fearful. Let's just hold off. Let's maybe close some positions. Let's reduce our exposure, whatever that may be. Then we need the trigger for a reversal. Now, next week, we do have CPI, and this will be a big, big thing. If we do get a on-target CPI of zero point 0.2, or if we get higher CPI, that will be okay. The Fed is not going to cut rates July. Sorry, the Fed might not cut rates in September. We're going to start buying dollars. It's cheap. We don't really have a reason to sell dollar anymore. Let's buy it, or at least let's close positions. Risk off events, obviously, the US dollar is still a safe haven, regardless of the movements. The fundamental of the dollar hasn't changed. Central bank divergence, obviously, we get the ECB or even the BOE starting to cut rates before the Fed does. That's when we could also see inflows back into the dollar. Trade war escalations, depending on the exact developments, we could start seeing the risk off tailwind from that affecting the dollar in a bullish perspective. Um, so that's it. So let's move on to the charts. So let's just have another quick look at the dollar before we move on. I know that, again, this has been more of a dollar focused webinar rather than a typical weekly outlook, but we are going to go onto some watch lists shortly. So COT, we have had a couple of times previously where we've got extremely crowded markets with COT. So you can see here, 57, over 50% shorts. What did they do? Well, at this point, the dollar bottomed and reversed. At this point, 58.5% of COT short, market reversed. Same thing here, 58.9%, the market revert. I mean, this wasn't as bad, but we did see that reversal. So the same concept applies. And right now we're 59.25% short. So everything is just screaming long buy dollar. Now, again, I'm not telling you to actually buy the dollar just yet because we do have CPI ahead of us. We've still got FOMC. So two triggers that could cause that reversal, but it wouldn't be a shock to me. Obviously, we haven't had the latest COT filing because obviously we normally get those on Friday, but we had July the 4th, so that was postponed. We'll get last week's COT on Monday or tomorrow. So it wouldn't be a shock to me if we do see short positions getting reduced and maybe even some long positions getting added. So there is that as well. We are coming down into a point where the dollar is becoming a little bit too cheap. So there is sort of a problem really. A currency cannot devalue continuously. We're not going to see the dollar just continue to drop to 80, 75, 70. That would cause massive problems within debt, trade, and the global economy. So the dollar will not just continue to fall. So I'm happy to bet that roughly around here, and again, I'm not quite executing just yet, but roughly in this area, I would quite happily start looking to take longs, low risk until we get that confirmation that we are in the right direction. Euro, similar thing. So the euro is extremely overbought on a technical view. I mean, we've got this multi-year. So again, similar to the dollar, this trend has been established since 2009, where prices failed to break any higher than the trend line, and we are at that level again. So if we do get that catalyst for euro to dump and dollar to rise, this would be a perfect short opportunity euro buy dollar. So that leads me on to euro dollar specifically. Now, again, as we've already looked at, euro dollar is extremely extended. So we've got our weekly 200 Bollinger right here. That does tell us this market's stretched. We've also got COT that's stretched. The RSI on the weekly is stretched. Even if we don't get a massive crash down to 1.2, 1.3, whatever it may be, we are due a pullback just from a technical view. So my first target euro dollar is at 1.15. So my plan going into this week is short euro dollar, and this will be very low risk, so it might be zero point 0.5. Bearing in mind, I normally risk 1.5 to 2% per trade. Depends on the exact trade. So zero point 0.5 for me is pretty low. Stop loss relatively tight around here. So the implication here is that euro dollar could, in theory, rise to 1.2. That's sort of the worst case in my view, because what I'm saying worst case because I'm bearish. I don't want this market to rise anymore. Um, but if it does, 1.2 is sort of the stopping area. I actually have some notes. Let me just try and find it really quick so I can reference it. Uh, Sorry, guys, bear with me. There was something about 1.2, and I just can't remember exactly what it was. But essentially, just to quickly recap it, 1.2 on euro dollar would cause inflationary risks with euro, and obviously with the dollar as well. So if Eurodollar does reach 1.2, the ECB is likely to step in. They won't intervene. They won't do anything like that. It's not like the BOJ, but they will likely verbally discourage people continuing to buy Eurodollar, which obviously will cause Eurodollar to go down. So if we do end up taking this trade and we are stopped out and price runs to 1.2, I will be shorting anywhere above 1.2 because that at that point it becomes a major problem for the ECB with the euro value. Um, so that's something to keep in mind. I think there's a huge potential here for us to get into some really, really, really nice shorts. But again, it's just the skill of executing and managing to wait. Because what we don't want to do is sit here waiting and waiting and waiting, and the market's just doing this, and we're just missing everything. So we may have to be aggressive depending on market developments. But anyway, that concludes the dollar section. If there is any questions, of course, please drop a message into the live chat. You can ask questions. I'll quite happily answer. Okay, let's move on to the general gist of what we do here, which is our normal market analysis. So Edgefinder is still reading bullish, bearish dollar, as you can see. Euro dollar is still reading bullish. We've still got dollar Swiss reading bearish, although it's calmed down. GU was there. EU was also the highest reading. We had dollar CAD, dollar Swiss bearish. Dollar yen was also very bearish. So we have seen last week's data has benefited some of that dollar bearishness. So dollar Swiss is still the most bearish asset, and if we were looking to go short dollar yen, obviously long dollar, that would be risky. So I would like to offset that with a potential short dollar Swiss, at least until we get a strong confirmation that the dollar could continue to run higher. That is one play. On the other hand, we could if we wait and do get some sort of confirmation that the dollar is done and we are going to continue higher, this would also be a beautiful long opportunity on dollar Swiss. Now, obviously, I'm taking a very contrarian view this week, and I just want to be very, very clear. I'm not going to be balls to the wall. I'm not taking high risk. I'm not even going to be taking a trade until I'm a bit more satisfied that we are done, whether it be a COT filing, whether it be CPI or FOMC. I just want to see that I'm going to be a bit more safe. So in this situation, if we did manage to get into a long dollar Swiss, I would very happily, and remember, this is the weekly time frame, so don't take these levels for gospel. This is just a rough idea. I'd be quite happy to go with something like this, stop loss below this weekly low. This would be a beautiful double bottom on a high time frame. And then we'd be targeting this triple high up here. I think this would be a really, really nice trade to be in. Next up, the DAX. As we just saw, the DAX is still the most bullish reading, and we have seen consolidation on the H4. Obviously, we had US markets closed Friday, so it's not a surprise. So I'm looking for a very simple trend continuation. The market technically is still bullish. Obviously, we've had a huge, massive recovery since we had the tariff drop, as I mentioned earlier in the meeting. So as long as we can get some sort of bullish momentum Friday London session, I may be a buyer as long as we can see this market catch a bid and we just follow momentum, trail stops, no take profit. Because if you're not aware, when we're trading markets like the DAX, the S&P, NASDAQ, whatever it may be, uh, the general drift is to the upside. So it makes sense if we can catch a nice move to the upside. Why not just trail stops and just maximize that whole move rather than trying to take our profits too quickly? So that's the thought process there. Next up is dollar yen. I'm actually not that interested in dollar yen, although I do think we could catch a correction again. This is just a bit of contrarian view on the dollar if we do start seeing that US dollar start to pick up. Silver, I would love to go long. I've been looking at silver for quite a few months and I've had a target in mind at 40. Now, I've been in and out of silver, I think towards the start of the year, and I was caught off guard a couple of times, made a little bit of profit. It was nothing too major, but I've missed this whole upside move really, which has annoyed me quite a lot. So I'm looking for any type of pullback. The market is technically overbought. We're still holding above our 200 Bollinger on the daily. The monthly is overbought, and the weekly technically is also overbought. So I just want to see some sort of pullback, whether it just be into previous structure around here, just to sort of normalize price a little bit, bring it back down to 200 moving average, whatever it is. I'm not too bothered. I just want to see some sort of pullback that would allow me to buy in and target $40. Again, that's been the long-term target for a long time. So if we can get that, that would be beautiful. Pound Swiss. Again, let me just reference. I'm not sure. Yes, here we go. So pound Swiss is reading bearish. Let me, oops, let me just quickly consult my notes because again, I've not done that much on pound Swiss. So the Bank of England remains in a dovish stance. Further cuts expected. Inflation moderates. Short-term mortgage rates invert. Upcoming data. Okay, it doesn't sound great. The Swiss National Bank, the S&B remains cautious amid inflation concerns. Okay, so we've got a slight divergence there with the S&P holding cautious and the Bank of England with a dovish stance and further cuts expected. So it makes sense for us to look to go short here. And obviously, as we saw in the Edge Finder, we do have bearish data. So with that in mind, very simple momentum play, something into previous structure, maybe some sort of 50% pullback would also be relatively valid. So this would actually make quite a nice short setup here. So if we could come into our 0.618, stop loss above the high, take profit at the extension. I think this is a really solid technical trade. I think the central banks make sense as well. The downside is, again, as I've already said, a lot of these markets are really, really extended. So we would be selling into an oversold market. However, I'd be willing to take that risk if those fundamentals continue to play out in our favor for shorts. Last up is the NASDAQ. So again, as I said with DAX, we've already had a huge recovery. These markets have done very, very well in recovering from the tariff crash. So I'd be quite happy to go long, sort of 50% of the way into the fib 50% level, if that makes sense. Stop loss is tricky because the only real option is at the previous low, or we would need to be a bit more aggressive, something like this. Either way, I'm quite happy to take the trade. And again, we'd just be trailing stops, no hard take profit, and see if we can catch some sort of drift to the upside. With now, this might sound like I'm contradicting myself slightly, but as I said, I don't think we're going to get those rate cuts from the Fed. However, I think there is still a possibility of September rate cuts, which obviously will benefit the Nasdaq. And we've still got a lot of optimism within these markets. So I'm quite happy to go long on NAS and also long on the dollar, but NAS may take a little bit of a stop if we do get higher than expected CPI. Obviously, that will reinforce that Fed rate hold narrative. Excuse me. So that concludes this week's pre-market meeting. Again, there wasn't anything in terms of technical setups or trades in mind that are necessarily mind blowing. I think euro dollar is definitely the one I'm most interested in so far. But yeah, it's more a case of just watching the dollar, in my book anyway. But yeah, if there's any questions or anything you want me to take a look at specifically, let me know. I'm quite happy to do so. If there's Anything going on? If not, then we will call it a day here, and we will connect tomorrow. I'll give you a minute. I'm just going to take a. Oh, I don't have any water here, so Tom's typing, so I'll give you a second. Says James, no worries at all. Okay, guys, I will see you all very, very soon. Again, you do have that PDF on WAP, so if you want access to it, just go to your account, you'll have it. Guys, we'll speak soon. Thank you for being here. Enjoy the rest of your weeks, and I hope you enjoyed your weekends.